All right, let's just be brutally honest for a second. Most people who try to invest in the stock market, they lose money. Yeah, they treat it like a casino, they get burned, and then they spend the rest of their lives cursing the entire system. But you know what? The fault isn't with the market, it's with the method. Or more accurately, the complete lack of one. Today we're going to change that.
So I have to ask you, and I really want you to be honest with yourself here. When you put your hard-earned money into a stock, are you truly investing based on a system, or are you just gambling, betting on a hunch, a hot tip you heard somewhere, or maybe just a prayer?
And that right there is the absolute core of the problem. People mistake the thrill and the rush of gambling for the quiet discipline of investing. They get swept up in the hype, they start chasing these skyrocketing prices, and they almost always end up buying high and selling low. It's a perfect recipe for disaster.
This brings us to the single most important principle you need to burn into your brain. Look, in the short term, prices can be wild. They can be emotional, they can do anything. But over the long run, a company's share price will always, and I mean always, follow its ability to make money. It's like an iron law of the financial universe. A strong company will eventually see its price rise. A weak one will eventually fall. Period.
To really succeed at this, you only need to answer two simple questions. That's it. First, what company should you buy? And second, when should you buy it? If you can get these two things right, you've pretty much cracked the code. Now, these two questions represent two totally distinct skills. What to buy is all about fundamental analysis. That means digging into a company's actual health, its sales, its profits. Then you have when to buy, which is technical analysis. That's all about reading the market's mood through price charts. And you absolutely need both. A great company bought at the absolute worst time is still about investment.
So let's tackle that first big question, what to buy. We're going to use a really simple, repeatable 5-filter system. Just think of this as a way to systematically eliminate all the bad choices so we're only left with the best of the best.
Here's our roadmap. It's really straightforward. We're going to run any potential company through these 5 tests. And here's the rule. If a company fails even a single one of these tests, it's out, gone. No exceptions, no buts, no second chances. This is how we build discipline right into our process.
Okay, our first filter is super simple. Is the company's sales graph pointing up? We only want to invest in companies that are actually growing. If sales are flat, or even worse, falling, it's an immediate no. So as you can see, right off the bat, Tabit Labs is out. Now, sales are just the start. Our second filter, gross profit, has to be rising right along with sales. This shows the company isn't just selling more stuff, but it's keeping its profitability on every single sale. If that's falling, it's a huge red flag.
All right, next up is filter number 3, net profit. And this is where things get really interesting. See, a company's core costs, like rent, salaries, those are often fixed. So a small increase in sales can actually lead to a much, much larger increase in profit. We call this financial leverage. So if a company's sales are up, say, 10%, we want to see their net profit up by even more than that. If it's not, something's wrong with their efficiency.
Number 4 is earnings per share, or EPS. All this really tells us is how much profit the company makes for each individual share out there. And the rule here is incredibly simple. We want to invest in a company that is more profitable than its average competitor. The EPS must be higher than the industry average. No exceptions.
And that brings us to our final and maybe most crucial filter, the price-to-earnings ratio, or PE. See, the first 4 filters found us a really strong company. This last one makes sure we don't overpay for it. We want a company whose PE ratio is lower than the industry average. Simply put, we're looking for quality on sale. And this is a perfect example. Slotus is a great company, but it's just too expensive right now. So
there you have it. After that simple process of elimination, we're left with just one company that passed all 5 tests. We now know what to buy. We've identified a fundamentally strong company that isn't overpriced.
But, and this is a big but, that's only half the battle. Finding a great company is totally useless if you buy it at the wrong time. So now we've got to tackle that second question, when to buy and sell. This is where we learn to take emotion out of the equation.
Let me ask you this again, and be honest. Have you ever seen a stock shooting up day after day and you felt that anxiety, that fear of missing out, and you just jumped in? Probably right near the top, only to watch it immediately crash? That feeling, that's your enemy. You weren't impressed by the company's performance. You were impressed by the stock market's performance. That, my friend, is a gambler's move.
To avoid that trap, we have to understand how trends work. A stock doesn't just move in a straight line up or down, it moves in waves. A rising trend is just a series of peaks and valleys, where each new peak is higher than the last one, and each new valley is also higher than the last one. Our job is to learn how to ride that wave, not get crushed by it.
So here's the crucial point. We don't buy when the market is falling, and we don't buy at the peak of a huge rise. We wait. We wait for a clear, repeatable entry signal, and I call it the second up.
Just look at this pattern here. The stock goes from 20 up to 30. We do nothing. We just watch. Then it pulls back a bit, down to 25. We still wait. Then it moves up again and breaks past its old high of 30, hitting 40. That is our signal. Now why? Because the new low of 25 was higher than the old low of 20, and the new high of 40 is higher than the old high of 30. The rising trend is confirmed. This is a disciplined, systematic entry, not an emotional one.
And guess what? The exact same logic applies in reverse for getting out. We don't sell in a panic on the very first drop. We wait for the second down, a confirmed downtrend where a new peak is lower than the previous one and a new low is also lower. This takes all the guesswork and all the emotion out of selling. Okay, so we know what to buy and we know when to buy it. But how do you actually manage the trade once you're in? Because the goal isn't just to make money, it's to keep the money you make, and for that, you need a strategy. Let's just walk through a quick example. Let's say you followed the system and you bought 1,000 shares of a company at $100 per share. You've invested $100,000.
Now, before you even start dreaming about profits, you have to decide the absolute maximum loss you're willing to take. Let's say it's 10%. You set a mental, or an actual, stop loss at $90. If the price hits that, you sell. No regrets, no second guessing, you just get out and live to fight another day.
Okay, now for the good stuff. The stock starts to move in your favor, and it goes up to 120. What do? You sell a small portion, maybe 100 shares, just to lock in some of that profit. Then, and this is key, you raise your stop loss on the rest of your shares to 110. At this point, it is impossible for you to lose money on this trade. As the price keeps rising, you just keep selling little bits and raising your stop loss behind it, like walking up a staircase. You're letting your winner run while protecting your gains the entire way up.
I really want to leave you with this powerful thought. A foolish investor is a dangerous person. And not just to themselves. They don't just lose their own money. They get scared, they come out cursing the market, and then they convince everyone they know that the whole thing is just a rigged game. Investing without knowledge is far more destructive than not investing at all.
Look, what we walked through today isn't some magic formula for getting lucky. It's a repeatable system for putting the odds in your favor, day in and day out. It's the disciplined process that separates a gambler from an investor. If you want to become a serious investor, not a lucky gambler, stay with this channel.